Good morning, everyone. This is Marshall Giller bringing you the morning comment for January 23rd. Well, ECB President Draghi Thursday announced a much larger than expected quantitative easing program, sending the euro down sharply and pushing Eurozone bond yields to record lows. I expect the program to continue to exert downward pressure on the euro, particularly if Syriza wins Sunday's election in Greece and U.S. rate expectations continue to rise, as seems likely. The ECB's move was surprisingly large in both its size, 60 billion euros a month, and its duration, lasting at least until September 2016, or longer if inflation hasn't returned to target by then. So it's open-ended. As a percent of GDP, it's bigger than the Fed's program was, so it's quite impressive. The effect of the announcement was muted somewhat because of the non-mutualization of risk. The government bond purchases will be carried out by the national central banks, not the ECB. This is just a technicality for public relations purposes, because unless they put capital controls into place, the risk is still spread throughout the Eurozone. I was anxious to find out what the vote was to see how many people opposed the decision, but oddly enough, the ECB didn't vote on it. Draghi said that the majority was so wide that they didn't need to vote. This is a nice way to hide any objections and create a facade of unity. This is important to aid the psychological impact of the move. So, conclusion, more euro weakness to come. While the ECB's move did exceed expectations, it was nothing like the shock that the Bank of Japan delivered in October with its wholly unanticipated move. Yet, the range in euro-dollar was almost the same as the range in dollar-yen on that day, both around 3%. This suggests that the positioning in euro is lighter than it was in the yen. If so, there's still more room for short euro positions. The push may come from this weekend's election in Greece. Separately, on a different issue, Brent prices jumped after Saudi Arabia's King Abdullah died. The speculation is that Saudi Arabia will cut back on production to push up the price in order to ensure that it has enough money for a smooth succession. However, the rhetoric in Davos has emphasized the likelihood of a recovery in prices over the next year, as is reflected in the oil futures curve. I think the current Saudi policy has broad support in the kingdom, and so I do not expect them to change policy, and I do not expect today's rally in Brent to last. Highlights of today, Friday is the PMI day in China, or it's a PMI day. In China, the preliminary HSBC manufacturing PMI for January rose slightly but remained in contractionary territory. We also get the preliminary manufacturing and service sector PMI data from several European countries and for the Eurozone as a whole. In the UK, retail sales for December are expected to fall, a turnaround from the previous month. After Wednesday's surprise on the Bank of England minutes, a weak retail sales figure could leave sterling vulnerable. In the US, existing home sales for December are forecast to rise, in line with the housing starts and building permits released earlier this week. This may be dollar supportive. Chicago Fed National Activity Index and Conference Board Leading Index, both for December, are also coming out. Canada's CPI for December is expected to decelerate. Following Wednesday's surprise rate cut, a drop in the inflation rate could ignite speculation about further rate cuts and could trigger a push higher in dollar CAD. This weekend, as I mentioned before, Greece goes to the polls. The most recent polls confirm that a series of coalitions likely to win the election. It's still questionable, though, whether they'll get enough votes to govern by themselves or whether they'll need to form a coalition. What are the policies of the party? This is really complicated, and I can't go into all the details in a brief video, so please see the comment on our website for full details. But basically, they've got a simple and reasonable position. They argue that the country's debt at 177% of GDP is not sustainable. They want a debt restructuring and an end to the austerity programs so they can get growing again and have a chance to repay their debt. This is a reasonable position held by many mainstream economists. The only problem is none of the mainstream economists who hold this view are German. So Eurozone officials don't all see things this way. It's clear that the negotiations over this debt will be tough, and there will be many tense moments when the fate of the Eurozone seems to hang in the balance. But at the end of the day, I expect the election of Syriza will be a good thing for Europe, and that it would demonstrate that a change in policy can be accomplished without voting in the radical right, whom I see as a much bigger threat to Europe. Syriza's election and the successful renegotiation of its debt could prove a victory for European democracy, which is increasingly necessary for the Eurozone to continue. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.